If you are trying to get business credit and you have poor credit, I really want to share with you our top 5 hacks that you can implement today to really start boosting your chances of approval. So here are the steps I really want you to pay attention to. The first thing you want to do here is you need to know the types of bad credit business loans. See, if you're trying to really get business funding, you can't really target all kinds of business loans because all business loans are not created equal. So you got to pay attention to the type of specific business loans you want to go after because you need to actually boost your chances. So when we talk about business loans in general, you have a constellation of business loans. You have short-term small business loans. You have short-term business lines of credit. You have collateralized loans. So when we talk about collateralized loans, we're speaking about equipment loans. We're speaking about the revenue-based financing. We're speaking about all kinds of loans. You have commercial real estate loans. So any loan in which you have to provide collateral, you have to pledge an asset, is considered a collateralized loan. And you also have working capital loans. So the point I'm trying to make here is that you got to sit down based on your situation, based on the states and the city where your business operates from, based on the economic sector that you're currently in. You got to ask yourself, which type of business loan can I qualify for without too much difficulty? See, the thing is because you have to have some skin in the game anyway, but you have to make sure that you have as least skin in the game as possible. So when we talk about short-term small business loan, we're speaking about unsecured small business loans. When we talk about short-term business line of credit, we're talking about unsecured business line of credit. So the question to you is, you got to ask yourself, okay, I have poor credit and I'm trying to get business funding. Should I collateralize the business loan or line of credit? And even if I want to collateralize it, do I have the proper collateral? And will the bank or lender in general, like the bank or credit union or alternative lender, would they accept my collateral? So those are questions you got to really ask first, okay? And also, maybe you just need a working capital loan. And the thing is, when I was talking earlier about you having some skin in the game, you gotta provide something. Even if you don't collateralize the loan, you need to actually show something to the lender that, hey, listen, I have skin in the game. For instance, you can show your business financials. In other words, your business is doing great. Even though you have bad credit, you're still doing great in terms of business profitability. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. We're going to have an enriched conversation today. So the first thing you need to do is you need to know the types of bad credit business loans. The second thing is you need to know what lenders are looking for on a small business loan application. See, the whole thing here is that if you are trying to get business funding with poor credit, you need to have a clear idea, and I mean a very granular idea about the types of criteria that the lenders are looking for. So when you apply for a business loan, no matter your credit, no matter, you can have good credit, bad credit, so first of all, lenders want to pay attention to your annual revenue, so your business annual revenue. So when we're talking about revenue, we're speaking about sales, okay? And this is top of the line sales, not the net income, top of the line sales. So everything before you actually deduct all the expenses. So those are elements that really are sort of quite essential for the lender, because the lender wants to make sure that the business itself is profitable. Okay, speaking about profitability, the second criterion is profitability. So you have annual revenue, but you have also profitability. So profitability, that's really the net income. That's really the bottom line. So profitability means what? Revenue minus all your operating expenses, including taxes, okay? So, and that's important. And lenders also want to have a clear idea about your company's current debt obligation. So we're speaking about not only short-term loans, but also short-term business loans, but also long-term business loans. When we talk about short-term versus long-term when it comes to business loans, we're speaking about a timing criterion of 1 year. So in accounting in general, and if you have a short-term business loan, it means the loan is due within 12 months. If you're talking about a long-term business loan, you're speaking about a loan that is due after 1 year. So this is just some kind of technical aspect I want to mention here. And also lenders want to see the cash flows that are actually that revolve around the business. So when we talk about cash flows, we're speaking about cash inflows and cash outflows. So there is a statement. It's called a statement of cash flows that really informs the lender about your business ability to generate revenue, but also to generate cash flows. And also lenders want to pay attention to your credit history. We're speaking about your company's credit history, but also your personal credit history. And the final thing is lenders want to know something about your business plan. So those are elements that are important that lenders are looking for on a small business loan application. Boss, I want to quickly remind you here of today's topic. We are having a conversation about business funding with poor credit. So the next thing you have to do here is to improve your chances of obtaining business loans for bad credit. So number one, you have to know the types of bad credit business loans. Number two, know what lenders are looking for on a small business loan application. Number three, you have to actually improve your chances of obtaining business loans. Now, how do you do it? Well, that's what I was talking to you about earlier when I spoke about you actually having skin in the game, right? It's all about mitigating risk, but at least showing the lender that you also care about the business loan that you want to get. Again, when we speak about business funding, we're not just speaking about business loans, right? We're speaking about business credit cards, business lines of credit, working capital loans, all kinds of business loans that really will beef up your business's cash position. So there's one way to improve your chances of obtaining business loans is by providing collateral. So if you're able to provide collateral, you can actually boost your chances of actually receiving the funding that you need. Now, when we talk about providing collateral, what are we speaking about? Well, collateral can be all kinds of things. Collateral means, well, you are pledging an asset, or you can also try all kinds of collateralized business funding. For example, invoice financing. When it comes to invoice financing, you actually have skin in the game because you are pledging your invoices. Or accounts receivable financing. Accounts receivable is an asset, it's a short-term asset on your company's balance sheet, so it's considered collateralized funding. Or you can try equipment financing. Equipment financing is also considered collateralized financing because equipment is considered a long-term asset on your company's balance sheet. Equipment is part of something called property, plant, and equipment (PPE) on the balance sheet. So that's a long-term business asset. So that's number one, provide collateral. Another way to actually boost your chances of qualifying for business funding with poor credit is to use a cosigner. So it's all about you actually parlaying somebody else's great credit and actually using that to get a business loan. And when we talk about using a cosigner, that person can have either a great personal credit or great business credit. So all kinds of scenarios are possible here. The next thing you want to do here is to research your options based on eligibility requirements. That's what I was talking to you about earlier. See, all business loans are not created equal. All business credit cards are not created equal. All business lines of credit are not created equal. So you got to really position yourself and say, okay, you know what? I really want to boost my chances of approval. What kind of loan should I go after? And when we talk about business loans here, we're speaking about a few things. Okay, now eligibility requirements for most business loans that we have researched in the last 35 years. You have things like personal credit score, you have years in business, and you have annual revenue. So personal credit score, even though we're speaking about a business context here, personal credit score actually informs the lender about the business owner's personal financial discipline. That's why a lot of banks, a lot of credit unions, a lot of online lenders, a lot of alternative lenders care so much about your personal credit score. So this is one area where you have to pay attention to and say, you know what, can I qualify at all based on that criteria? Oh, well, I have poor credit. Is there any way I can just salvage my poor credit to actually beef up my chances of being approved? So the second criterion here is your years in business. So how many years have you been in business? We all know the stats in terms of business failure, business survival. So the longer your business has been in business, the longer your business has been in operation, that is, then the longer the more likely the lender will actually extend a loan to you. Why? Because they're thinking, well, you know what? If you have been in business for that long, you might have done something really well, okay, or you are doing something really well. And so the third thing is they also pay attention to your annual revenue, because it's all about profitability. It's all about you being able to repay the loan that you are about to get. So again, when we actually talk about business funding with poor credit, we are actually distancing ourselves at least temporarily, from the credit criterion and paying attention to profitability. Okay, your ability to generate enough cash flows to be able to repay the loan, and to be able, not only when we talk about repaying the loan, we're not speaking about just the repaying the principal amount, but also the interest. So those are elements that are really important. Okay, and so by the way, boss, I want to quickly remind you of today's topic. We are having a conversation about business funding with poor credit. The next thing, and this is the fifth hack that you want to do here, the way you want to apply rather, if you want to get business funding with poor credit, is to choose a loan based on business needs and credit score. See, the thing is, I've spoken to you earlier about a constellation of loans that you can actually find. Right? We went from equipment loans all the way to term loans, all the way to working capital loans. We talk about revenue-based financing. We talk about accounts receivable financing. So you have all kinds of loans, all kinds of business loans you can get. Now it's all about filtering. It's all about going granular on one or two. And the thing is, the way you choose is that you have to choose a loan based on business needs and credit score. You can't just get up and say, you know what, I want this loan and this is the loan that I want. No, you have to actually gauge your chances of being approved. Because, you want a loan, you want this particular loan, but you can't qualify. Do you qualify? Can you qualify? And so sometimes it's all about looking at your situation and saying, okay, you know what, where I'm at right now from a financial perspective, this is the kind of a target I can easily get. You always have to go through, always have to go to the low hanging fruits. Okay. Now, when we talk about eligibility, you have a variety of factors that contribute to your eligibility for a business loan. So, for example, you have to ask yourself, which category are you in? New businesses or startups? Owners with a credit score under 550? Owners with a credit score over 550, over 500, over 600, over 700? Now, obviously, you have bad credit, so you have a credit score, a personal credit score that is below 579. Now the question is, are you generating revenue on the business side? Do you have large unpaid invoices? Do you have equipment needs? Do you have all kinds of expansion needs? It's all about not only your poor credit, that's true. Your poor credit plays an important role when it comes to determining your eligibility, yes, but also your business profitability also plays a quintessential role. Now, when we talk about business profitability, I'm speaking about the current profitability. In other words, when I look at your income statement, I am looking at your revenue. I'm looking at your expenses. I'm looking at your net income. But also, I'm talking about your business plan, because now we have to pay attention to the future, right? What is your business plan? So those are all elements, when taken collectively, can play an important role on your ability to be approved. Let me give you a few pro tips here so we have a clear idea of what we're talking about. You need to understand, when we talk about getting a business loan in general with bad credit, your credit score will always matter. Your personal credit score will always matter, okay? And again, even though you're getting a business loan, your personal credit score will always matter. So what you want to do here is that you want to be in a situation where you are constantly beefing up that credit score. And so that's number one. Number two, you have to understand that your business credit score also will play an important role. Now, business credit score may or may not be important depending on the loan that you're looking for. See, lenders, if they are going to give if they're going to extend you a long-term business loan, that's when they start caring about your business credit score as well. But if they're giving you like a short-term business loan, like let's say 1 year or 18 months, they care more about your personal credit score. That's just what our research in the last 35 years has shown us. So what we have to really look at the duality here. We have to look at two important criteria: your personal credit score and your business credit score. So when we talk about your personal credit score, we're not just talking about your business credit score with Dun & Bradstreet. A lot of business owners, they care more about one credit bureau and they don't care about the other two, but you have to care about all the three, because business lenders, they pay attention to all three. They pay attention to Equifax business and to Experian business. Okay, so all three, Dun & Bradstreet, Equifax, and Experian. And so it's important to understand that there is a strong correlation. There's a strong relationship between a personal credit and business loan approval. Again, and this goes back to what I said earlier, that you are the business owner who actually must demonstrate a certain level of financial discipline. And lenders are thinking, okay, if this person can actually demonstrate a certain level of financial discipline in his or her personal life, chances are he or she is going to demonstrate the same level of, I would say, financial adroitness in the way he or she manages the business affairs. So this is why lenders always pay attention to that. You have to understand, business credit scores also have an important role, an important impact when it comes to interest rates. It's just a matter of risk mitigation, okay? The higher your business credit score, the lower the interest rate, and vice versa. There is an inverse relationship between the two. And as you are trying to get business funding with poor credit, you got to really have a discussion, at least some analysis between online lenders versus traditional banks and our credit unions. You need to understand, you have more chances. So there are two scenarios here. If you're trying to really get business funding with poor credit and you want to go with a bank or a credit union, you better have a strong relationship with that institution. If you have a strong relationship with that institution, then we're good to go. And the way it works is that when I talk about strong relationship, we have coined actually a term here called MPR, multi-product relationship. So we're speaking about you having all kinds of checking account, business checking accounts, and business savings account with the bank or credit union. And we're talking about also you having some kind of business relationships. In other words, you also have business. You're using the bank or credit union for your payment processing, for your payroll, for instance. So basically, you have like a solid relationship with the bank or credit union. So that's number one. The second thing is, this relationship that I'm talking about has to be like over several years. Okay, if you have those two elements, it doesn't matter if you have poor credit, you can still qualify for business credit. Of course, I mean your business must generate enough revenue. Okay, so that's if you go for traditional lenders. Now, if you want to go for online lenders and alternative lenders, really there is no relationship that really matters that much. What matters here is the business plan and your business profitability. Okay, because at the end of the day, when we talk about the relationship between a business loan cost and your business and your personal credit, is all a matter of, as I said before, inverse relationship. Okay, and so when we talk about business loan cost, let's talk about the things that really matter. There are some costs that you have to pay attention to, no matter which lender you go to. The APR, the annual percentage rate, the down payment, the origination fee, the underwriting fee, the closing cost, the other fees. You just have to pay attention so that you don't actually end up on the wrong side of the equation where the lender who is charging like crazy amount of rates. There has to be rate. I mean, they will charge you rates anyway, but those rates better be reasonable so that you don't actually end up paying so much. Okay, so that's really the kind of conversation you got to have with yourself or with your team if you are trying to get business funding with poor credit. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about business funding with poor credit, and I share with you 5 hacks that will help you a lot when it comes to getting business credit with poor credit, poor personal credit, of course. So, number 1, know the types of bad credit business loans that are available. Number 2, know what lenders look for on a small business loan application. Number 3, improve your chances of obtaining a business loan. Number 4, you want to research your options based on eligibility criteria. Number 5, you want to choose a business loan based on business needs and your credit score also. And I share with you a few pro tips to kind of help you out. Thank you so much. God bless you. I'll see you next time. But until then, remember, stay marvelous.